Please like and subscribe. The Great Recession of 2008 was a global economic downturn that lasted from 2008 to 2009. It was one of the worst economic crises since the Great Depression of the 1930s. The recession was triggered by the collapse of the housing market in the United States, which led to a financial crisis that spread to other parts of the world. The roots of the recession can be traced back to the early 2000s when the U.S. housing market began to boom. Lenders were offering subprime mortgages to people who couldn't afford to repay them, and home prices were rising at an unsustainable rate. Homeowners were taking out mortgages with adjustable interest rates, assuming that the value of their homes would continue to rise, allowing them to refinance their mortgages at a lower rate. However, in 2006, the housing market began to slow down, and by 2007, it had collapsed. Homeowners who had taken out subprime mortgages found themselves unable to repay their loans, and banks began to foreclose on their homes. As more and more homeowners defaulted on their mortgages, the value of homes began to plummet, and banks were left with a large number of foreclosed properties. The subprime mortgage crisis quickly spread to the financial sector as banks and other financial institutions had invested heavily in these mortgages. The decline in home values resulted in huge losses for banks and investors, leading to a credit crunch. Banks were no longer willing to lend money to each other, and the stock market began to plummet. The economic fallout of the Great Recession was felt across the world, with many countries experiencing job losses, business failures, and a decline in economic growth. The recession was particularly devastating for the United States, with unemployment rates reaching double digits and the country experiencing its worst economic contraction since the Great Depression. Governments and central banks around the world implemented various measures to try and mitigate the effects of the recession. The U.S. government launched a series of economic stimulus packages to provide relief to businesses and consumers. The Federal Reserve lowered interest rates to near zero, and the government provided billions of dollars in bailouts to failing banks and other financial institutions. The Great Recession highlighted the need for stronger regulations in the financial sector and greater oversight of the housing market. The Dodd-Frank Wall Street Reform and Consumer Protection Act, which was passed in 2010, aimed to prevent a similar crisis from happening again by imposing stricter regulations on banks and financial institutions. The effects of the Great Recession were felt for several years after it officially ended in 2009. While the U.S. and other countries slowly began to recover, the economic fallout had lasting consequences, such as increased income inequality and a loss of trust in the financial sector. One of the most significant impacts of the recession was on the job market. In the U.S., millions of people lost their jobs, and the unemployment rate soared to 10% in 2009. Many companies were forced to cut back on expenses, including salaries and benefits, to stay afloat, leaving workers struggling to make ends meet. As a result, many people were unable to pay their bills, which led to a rise in foreclosures and bankruptcies. Small businesses were also hit hard by the recession, as banks were less willing to lend money to them, and customers had less money to spend. Many small businesses were forced to close their doors, while others had to cut back on staff and expenses to stay afloat. The housing market was also significantly impacted by the recession. The collapse of the housing market led to a decline in home values, which left many homeowners owing more on their mortgages than their homes were worth. This made it difficult for people to sell their homes or refinance their mortgages, trapping them in a financial bind. The Great Recession also had an impact on global trade. As demand for goods and services decreased, countries that relied on exports, such as China and Germany, were hit hard. Many countries also implemented protectionist measures, such as tariffs and trade barriers, to try and protect their economies, which further complicated global trade relations. In the years since the Great Recession, many countries have implemented measures to try and prevent a similar crisis from happening again. For example, the European Union has implemented tighter regulations on banks and financial institutions, and the U.S. has implemented the Dodd-Frank Wall Street Reform and Consumer Protection Act, which aims to prevent another financial crisis by increasing oversight and regulation in the financial sector. In conclusion, the Great Recession of 2008 was a significant economic crisis that had far-reaching effects on the global economy. While countries have taken steps to prevent another crisis from occurring, the impact of the recession is still felt today, particularly in terms of income inequality, job insecurity, and a loss of trust in the financial sector. Thank you for watching. Please like and subscribe.